Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about how to grow a portfolio to $100,000. So for this particular portfolio that I took some screenshots of, we started at around $25,000, and then we have since gone to around $50,000. And I haven't been really videotaping my progress, but I do want to make a series out of this where I report on this particular portfolio every single week on Fridays. And the goal for this portfolio is we're going to take this $50,000 portfolio and we're going to get it to $100,000 in the next 2 years. Preferably, we're going to be able to do this in just 1.5 years, but I do want to give myself a little more time because right now we are in a bear market and a full-on recession in the economy. So I'm going to be videotaping my progress for this particular portfolio. Now, if you're new to the channel, you know that I have around 4 to 5 portfolios, depending on if you count cryptocurrencies as a portfolio. But for this portfolio, this is the strategy that I advocate that basically everyone does because it's a relatively safe strategy for investors to build wealth over the long term. And this particular series is going to be about growing this specific portfolio to $100,000 in a very short time period. If you can see from these snapshots of my portfolio, over the past month, we have lost not that much really, only $2,321. And the reason why that's impressive is because this portfolio performs better than the majority of other portfolios and other investors on the stock market because it's very risk averse. I have very safe investments and it's extremely diversified. So while the stock market is falling, I really don't lose that much money in my portfolio, and that's when it shines. Also, later in the video, we're going to be going over some of the investments that I have in my core ETFs that make up this particular portfolio. But if we look over for the full year, you can see I'm not even down. I'm actually up almost $25,000. Right now, I'm up around 83.67%, and that is an increase of $22,788. Now, the way I invest is I invest very safely into core ETFs and individual investments to where a falling economy can actually benefit my particular portfolio. But without further ado, let me introduce you to a portion of my portfolio and the ETFs that make it up. We're going to start off with the Momentum ETF, ticker symbol MTUM, and this is a Momentum Dividend ETF. Essentially, this investment will rebalance itself every 6 months, and it will buy the stocks with the most momentum on the stock market if it meets certain criteria, and it also gives me very consistent dividends. So we're basically mixing growth and dividends, which my overall portfolio is reflecting. The next ETF that makes up my core holdings, and remember, for me, a core holding for a portfolio should make up between 40 to 80% of your portfolio, and it just so happens that my core holdings make up around 80% of my portfolio. But what is my next core holding? Well, that's going to be ticker symbol and ETF SCHD, which is a dividend ETF. So this gives me passive income in the form of dividends. I then have a drip investing enabled where I reinvest those dividends back into the ETF to where I get more dividends next time. And this strategy works extremely well during times of stock market uncertainty or while the stock market is falling, because as the stock price decreases, the dividend yield actually increases, and by me reinvesting those dividends back into the company at a lower and cheaper price point, I get even greater dividends even once the stock price rebounds. So that's why I have SCHD as one of my core holdings and ETFs. The next one I have is, of course, ticker symbol QQQ, the classic Nasdaq 100, and this is made up of a lot of different technology and growth stocks. And so far, all of these have been equally weighted from 20%, 20%, 20%. I have a 20% allocation in MTUM, a 20% allocation to SCHD, and another 20% allocation to QQQ. Now, the reason why I have over a 5% allocation to these particular investments is that these are not singular growth companies. If you all know me, I don't invest, or I don't try to invest more than a 5 5% initial allocation into singular risky growth companies. So if it's a singular company, I'll actually only take around 2% of my portfolio and allocate it to that particular investment, and I'll use the remaining 3% to dollar cost average down my costs. But for this particular video, we're going to focus on my core investments, and we will save the next 20% or the remaining 20% for another video. But I will give you a quick look in terms of my overall progress and my investments by looking over at this spreadsheet that I have laid out for you all that tracks the growth, the current stock price, the future stock price, and the dividend percentage yield. And lastly, to cap out my core investments, we have one of 4 ETFs. So I really, just depending on what type of mood I'm in, I will either invest to VTI, VOO, IWY, or RSP. Now, RSP and VOO are very similar because they both track the S&P 500, except RSP is an equally weighted S&P 500, while on the other hand, IWY tracks the best growth companies from the Russell Index, while VTI tracks the broader stock market. So with that out of the way, actually, let's dive into my spreadsheet to where the next 20% of my overall portfolio is composed of, and clearly I couldn't write them all out. Also, I want to say that there is some cross-contamination of my ETFs because a lot of these stocks actually track the same investments, mainly being Apple and Microsoft. VTI, VOO, IWI, QQQ, and MTUM track and hold a large portion of their allocations to Apple and Microsoft, and Apple and Microsoft are my number one holdings from ETFs. However, I don't really own a lot of them individually. The rest of my portfolio, because right here we only have 80% made up of my core investments, but the next 20% is made up of a plethora of other companies, probably over 300 companies in total. And this is what I mean by that. You can see here from the spreadsheet that I have a load of different companies with a lot of data that I am tracking from my particular portfolio, and a lot of these have very strong dividends, which is why my portfolio reacts so positively and performs very well during times of stock market uncertainty, or recession, or a stock market crash. From this particular spreadsheet that I have, I am tracking well over 300, almost 400 different companies that are mainly comprised from the S&P 500. But sometimes I want more allocation to these particular companies than the S&P 500 actually gives me. But what I really want to hone in on is their overall dividend yield, because this is really the bread and butter of my portfolio. Now, if you're not familiar with me, I am a growth investor. I'm a long-term growth investor. I like identifying undervalued growth companies and investing into them, or even strong growth companies that are going to continuously give me returns in terms of stock price appreciation. But for this video, I just want to focus on the dividend portion of my portfolio, which is the smaller portion of my portfolio. Like I said, in the next video, we're going to focus more on that 20% in regards to the growth companies that I personally own. So you can see very well-known companies such as Target, Lowe's, JP Morgan Stanley, some Microsoft, not so much. The only reason Microsoft's on this list is because they're already a part of my ETFs. You have T. Rowe Price, Broadcom, Visa, and many others. But let me first adjust this to say that not all of these companies are necessarily high dividend yielding. For instance, I really like Costco, and I bought Costco recently, as well as Visa and a couple other companies that are not focused on dividends. These are more of my growth companies, but still give me a dividend. Now, if we really want to focus on the companies that I am buying with the high dividend yield, you can see on screen right here, these are the companies that are keeping my portfolio afloat because they are jam-packed with value and they are allowing me to compound my overall dividends by reinvesting these particular investments. So this is just a snapshot of my overall portfolio and the various metrics that I am tracking with my overall portfolio. And a lot of this information is actually what I learned in business school in terms of identifying companies with very good credit ratings, not too much debt on hand, have very strong accounting ratios, and are overall growing at a substantial rate, which I would like to match. Now, if this is somewhat too much for you all, remember that I do release certain videos every once in a while about the companies and stocks that I am buying. We have stocks that can make you a millionaire by 2030. Clearly, that's going to be more growth focused. We have other stocks that made me rich in the first place, some of my top 10 favorite investments that builds wealth over the long term. You get some of the best stocks to buy now, cheap stocks and value stocks to buy right now, top 10 stocks to buy on the stock market, and many others. We even have some that could 10x over the next few years. So clearly, I am giving you all exactly what I'm doing, but for some reason, this is just not gaining much traction among certain investors. This is literally what I am buying and selling, and when we analyze the various articles in these videos, I will actually most of the time tell you my personal educated opinion on these companies that we are reviewing, because remember, it's not like I'm buying all 10 of them. Normally I highlight maybe 3 to 5 in that particular article that I am buying at that time. But again, it's all up to you, and you need to do your own research, and you need to make sure that these particular companies match your specific allocation. I even identify value stocks and dividend stocks and growth stocks, so it really doesn't matter what type of investor you are, you can definitely benefit from these types of videos and the articles that I analyze from stock professionals. Also, I do want to say that I do plan for this portfolio at its current growth rate to reach $100,000 in less than 2 years, especially considering the current growth rate that the portfolio is currently growing at. So remember, if you want more videos like this one, and for me to analyze and go more in depth why I'm invested into certain companies, why I choose to allocate 80% of my overall portfolio to ETFs, and then leave 20% to single more risky growth companies, go and show your support by smashing the like button, commenting your thoughts down below, subscribe if you are new, and I will see you in the next YT video.